All right, good morning, everybody. TGIF. So we made it through the Bank of Japan rate decision. They had telegraphed well enough in advance, something that our FOMC fails to do, that they were going to raise rates, and so we didn't get a sustained impact from it. I'm a bit surprised myself, but I'm glad it worked out because that really was getting a little worrisome. Now that they've managed to do it, and this is the first time they've managed to even talk about raising rates without causing troubles in the market, but actually getting the rate raised. We now have to think about what their final target is going to be, right? If they're now focused on getting to a neutral rate, then, well, we got to figure out where neutral is, which is a mythical, hypothetical level. And then they have to get there. So we'll see how that goes throughout the year. But it does take off the idea that Janet Yellen's replacement, Bassett, the tactics and shenanigans that he would have to deal with when it comes to Japan are now kind of moot. We don't have to deal with it. So the grind higher for the years still looks good. It's on track. We always have bricks in the wall of worry to be concerned with for sure, but that's one brick we no longer have to worry about. So Japan is up more than 0.75%. UK down a little more than a quarter. Hong Kong, which China's got their new year that they're going to be closed for from January 28 to February 4. They'll open back up on the 5th. You know, I've been talking about the March meeting that they have over in China and how that's the goal or the target for the really big stimulus push that's going to really bring back those China ADRs. I think they're going to front run it, right? I mean, I would, and of course anybody else, they always do that, right? Sell the rumor, buy the news, or buy the rumor, sell the news. There's always front running. I would expect that to start really picking up when they come back from the New Year close, right? So February 5, those China ADRs, and for me, playing China also includes playing copper. Copper for a number of reasons, but also because of the whole China stimulus push. So Baba, Baidu, JD, PDD, XPEV, NEO, the whole group, they're very likely going to be a dud for a week with China being closed. Then we come back Feb 5 and let the games begin. The good thing about it is we have some time before that happens for all of us to consider, what route or what direction we want to play that in. And you can just play the basket of stocks, right? You don't have to try to be a stock picker. You can just do something like KWEB. This is the China Internet ETF. It's similar to like XLK for us. It's not exactly the same thing because XLK is technology and this isn't. This is more of internet. Either way, it is a preferred vehicle. If you want to try to play China as a group, take that route. But I wouldn't do it yet. There's likely to be a lack of liquidity, through the holiday first. So for us today, we've got to get through PMI, and we need to focus on the events that we have coming up next. We've got FOMC, QRA, and those two are going to be really big. Not necessarily the first FOMC, but their forward projections. And there was news yesterday coming out where Trump was chipping teeth saying that he wants interest rates down and that the Fed needs to start cutting and that the whole world needs to follow us as we start cutting, everybody else starts cutting, and that he wants to pressure the Fed to do that. Now, it's not supposed to work that way. Fed is supposed to be independent and making decisions based on blah, blah, blah. But whether or not he gets it done, it's the sentiment behind it. The idea that he wants to increase the animal spirits, so to speak. So if you've ever studied the plunge protection team tactics and how they don't have to buy anything, right? If the markets are selling off really hard and they need the market to be protected or defended, and then you get the PPT, the plunge protection team doesn't have to come out and buy a bunch of stuff to lift the market. That would be crazy. All they got to do is come out and talk about things, about easing liquidity and, talk about stimulus measures, propose changes to existing throttles on liquidity, and we can see amazing reversals in the market from that. That's one of the premier tactics of the plunge protection team, is just to come out and start making those sort of comments and turning things around. We can see the red impact. So PMI has a history of causing volatility. It is today, so something to be concerned with. Once we get into the afternoon, though, things should calm down a little bit. Keep in mind, we are going into the weekend before some really big stuff, right? With the FOMC, we got GDP and QRA. So it's possible we could see sort of a hurry up and wait mentality. Now, I'll warn against that, right? That's the base case arguments. We'll go sideways, we'll wait on those events. But we've seen before where we were supposed to go sideways and wait, which means we get that lowered volume or lowered liquidity. And because of that lack of liquidity, if there's still big funds like CTAs or volatility control funds that are obligated to buy, the VC funds are obligated, they'll be going in there buying anyways. And since they're buying in lower liquidity, they'll drive price and will make big moves. Can't remember how many FOMC events when I was doing my research where FOMC being on Wednesday typically, and we'd start the week on Monday saying, yeah, it's FOMC week, we probably won't go anywhere. And we get to the entire week's expected move by the end of Monday. So base case, we go sideways into FOMC, but it's still a little ways out, right? We see the numbers here, the 24th, and then the 29th, the 30th, the 3rd, and the 5th. So we got a little bit of time. But you want to be thinking about how we're going to play this. And whether or not we're going to end up sideways. We did see the call wall roll up. Remember, we were tangled up in it. And one of the things we were looking for is to see that call wall get rolled and not be rolled from, contract changes or OPEX or anything like that. It's called an overnight roll. That's what we have. That is a bullish move when you see that happen. Now, we've still got the put wall all tangled up with the volatility trigger and the zero gamma. It's okay. I'd like to see some input on the founder's note on this, but if you read the PM edition, they were pointing out the very strong positive gamma conditions that we're in. Remember, in positive gamma, if we break out, market makers will sell into that breakout. And that limits how far we can break out. It doesn't mean that we can't continue to run on a breakout, because we can. Just like, earlier this week, this was Tuesday's close. Wednesday after hours, we continued to run into Wednesday's regular trading hours, and we continued to run even more. That was in positive gamma, and we continued to drive up anyways. But they were selling into it the whole time. So imagine if they weren't selling into it, how much further it would have gone. With the call wall overhead, it does give us a bit of a ceiling or a target to aim for. It's not too far out of the way either, just what, 30 points from 45 to 75. And a fade back down would put us into the volatility trigger first, then the put wall second. We want to stay above that 0 gamma or absolute gamma level. We're running VWAP reciprocation this morning. What we get below, we are getting above. It's very likely that we're going to run that dynamic until something breaks. So just kind of keep that in mind. Generally, when we get that sort of reciprocation pattern, it'll start to spread out like a megaphone pattern. So don't be surprised, if and when we come back up to this tweezer top, that we don't expand above it a little bit higher, and then down here expand below it a little bit lower, just sort of spreading out that consolidation into a sort of megaphone shape where it would broaden out until it finally breaks. For the week, we got to try to consider how this week is going to end, what it will look like on the higher time frames, and then what that lines us up for next week. So we are on a weekly chart here. We have a bit of a divergence between the cumulative volume index and what we're seeing in price. Price is pointed to the upside. It's very nearly back to all-time highs and getting ready to break out, while the indicator is sort of flattening out a little bit. So the week isn't done, which means the indicator isn't done either. But we don't want to see this, roll over or give any sort of signal of weakness, indicate divergence. So of course, the immediate question is, well, where are we going next? Nice, clean, round number, 6,200 on the breakout. From there, we'll either digest the LZ, the liquidity zone, or we'll continue to drive through that into 6,250, another nice, clean, round number. That would be a 1, 2, 3, 6 breakout, and we would expect opposite candle color at that spot. Of course, this is a weekly, so it could take 1 week, 2 weeks to get there. There's no time frame on that. Now that we're above 6,100, we want to keep it. Now we can wick back down below it. That's not an issue. And like we were talking about yesterday, we've had this nice, clean, systematic move to the downside, and we've now run up and we've broke that key level, and then we broke that key level. Now at some point we have to pull back. It's what markets do. We know we're going to go to the downside. We have to. The question becomes, well, how far are we going to come down? Maybe just a little bit like that right there, or something a little bit deeper. And how far would be too far? The easiest answer to that is 50% of this entire range. So if we measured that from high to low, we'd want to mark out the 50% level and say it really needs to stay above that. Well, that comes out to about 6,000. Nice and clean. It's 100 points lower. Lots of structure around that 6,000 level. I really wouldn't want to see it close below 6,000. We could get there. We could even get underneath it, but I'd want to see it come back up again. And, we don't want to see it fall that far down in the first place. But if we did get weakness to that depth, it would still be okay. If we think about the typical dynamics on price action as it's trending, when price is running up and then people start taking profit and it pulls back, that pullback from profit takers should immediately be bought up by others who are ready to jump in it and take their place. It shows the health and the strength of the trend. If we don't get those buyers stepping in hungry to and happy and willing to take the place of those who are leaving, then it really starts to fade back, right? That's why if you use Fibonacci, they've got the 786 and the 618, and then you got the half. So if we're measuring something like this and we're looking for the next pullback, 786 is a really good level as a line in the sand for how much pullback should we tolerate. I don't like it getting below 786 and getting into something like 618. 618 may have been okay with delayed data back in, the mid 2000s, but those days are gone. So if we did snap something like a generic fib on here and put a 786 to it, $60.80, which would be just below this last pivot, say as an overshoot, a little bit of digestion, and then a continuation. So getting below that, it won't be the end of the world. I just wouldn't like to see it. But definitely closing above 59.80, that's something that we want to continue to do. All right, so had some questions on this. These purple lines are a floor pivot. So on any platform, you can just bring up floor pivots and you'll get that purple line. We got a weekly floor pivot. That's the bigger line down here that spans for the entire week. And then we've got daily pivots that just span through the entire day, right? That's all that it is. Now, I have a channel around my floor pivot. That would be like a central pivot range, CPR. So depending on your broker, you can search for CPRs. TradingView's got them. So it's a floor pivot with an additional channel that is just mathematically based, right? That's all it is. And floor pivots have S&R levels, support levels and resistance levels, and all of it is math based. So while TradingView has the central pivots, Thinkorswim doesn't. So I just, coded in the central pivot ranges. Understanding what a central pivot range is, the math behind this floor pivot, there's plenty of books out there that talk about floor pivots, the calculations behind them, how they work. I've shared books with people, about pivots, and that central pivot is in there. It's discussed quite a bit. So that's where the logic behind all of this comes from. I didn't create these channels. I didn't create the concept of central pivots and floor pivots. It's been around for a long, long time. Even the idea of whether or not the channel is narrow or wide and what price should do with it, that logic has been around for a long, long time. What we've been focused on this week is how far away we are from this floor pivot. That's the weekly pivot. And I've tried to define over the years how far is too far. I haven't found a good way to do that. Even trying to normalize it for each product, like, the ES, how far it gets from its weekly pivot would be completely different than Campbell's Soup and how far it goes from a weekly floor pivot. So even if I just try to normalize it for any single individual product, I still haven't had much success. But it is something that I focus on. And one thing I found over the years is that price will tell us when it's gotten too far away from that pivot, because it'll do things like it did yesterday and Wednesday. So Wednesday, it set a really good distance, and then it just really struggled to get any higher. And then Thursday, it got back to that same spot, struggled to get higher. And finally, yes, now finally, we got that breakout, and it needs to keep it. Otherwise, this will be like the last hurrah or a mini blow off top as it's trying one more time to expand farther away from this weekly pivot. And if it doesn't manage to do it, and we break back down below this resistance that we were hitting Wednesday and Thursday, then we can test Thursday's low and maybe get into Tuesday's price action. Now, that's a big move for a single day on a week where we're supposed to hold the line after having just a really good week. So let's see if we can avoid doing that. If you think about it, it has been a really good week. We've had some nice expansion. And we don't want to get too overbought, right? That's when markets get a little wild and a little crazy. So getting a red day, something that looks a little bit like that, a little bit of a pullback, not a big deal. That would be a really good day to set us up for next week. There is something called a 5-bar rule. And of course, it just gets into like counting candles, and it's not really my jam, right? It's not my thing. But it's been around for a long time for a reason, and a lot of people tend to pay attention to it. We don't have our 5th bar yet. We're just now developing the 5th bar. But yesterday when we were doing all this, it was red, right? Or a couple times this week when we were starting the briefing on the day, it was red, and none of them closed red at the end of the day. It's possible that we yet again don't close red. Just keep in mind that breakout point that we were talking about, this structure from Wednesday. And it's just the idea that we got up here and we got tangled up and we weren't really able to get through that spot. And then the same thing yesterday. And we're kind of holding on it now like a Busby, right? We had resistance, we broke out of it. Now we're coming back to test old resistance as a new support, the very definition of Busby. And we did it. We need to keep it. We have an MDP at this point. It's a missed daily pivot. Just as simple as it sounds, this purple line is the floor pivot, and we haven't hit it yet. That's all it means. And we don't use it for today, though. We would use it for tomorrow. And by tomorrow, I mean Monday. If you want to understand more about missed daily pivots, that's also a concept that I learned along the way. It's not mine. I didn't develop it. You can just search on Google or YouTube missed daily pivots. You'll find the guy that did really bring that to the popular conscious. Get an idea of it. It's a trading strategy, which I don't use it as a trading strategy. I just use it for analysis. A lot of the strategies that I've learned over the years, I don't trade with them. I just use them for analysis. 60-30 is the point of control for this week. We were talking about that liquidity from Wednesday as the point that we kind of need to hold above. Well, that's where this line really developed anyways. And we reinforced that more yesterday afternoon. And now that we've broke above it, we kind of want to keep it. We want to see this get defended if we actually get weak enough to come down and test it. The concern would be breaking Thursday's low and this shallow spot. It is interesting to note with this Thursday low that we have this shallow spot. Generally, when we move up really fast, we make a shallow spot like that. And generally what happens is if you start to fall back down through the shallow area, you move through it really fast, which is not what happened yesterday. We hit something and bounced back up again. Well, we didn't hit liquidity, that's for sure. So it could be that the ES hit something, or it could be that an inverse product or even a correlated product, something that was moving the ES hit something. Dollar, yields, bonds, volatility, something. So when you see the product that you're trying to trade suddenly hit something, turn around and go the other way, and you're trying to ask, what the heck did we hit? There's nothing down there. Yeah, maybe there is. I didn't say that there wasn't anything down here, but it's also the nice round number 6,100. So it was an options level, solid structure when it comes to options. There was that. There could have been, volume profiles from a different time frame, some moving averages, a floor pivot, VWAP, who knows what was there, right? You can go look around, maybe you find something, maybe you don't. But if you don't find something, it's very likely that whatever was moving your product, dollar, bonds, yields, it hit something. We are above all of the moving averages, by the way, so we don't have anything of concern with those. Still have a discrepancy between the 10-day TPO and the volume profile. Still looking for TPO to normalize. And there's nothing here, right? If we're looking for classic shapes, we don't have one on the profile right now. It's just trash. Now, as we wear out more of these candles from the left by making new candles on the right, it's very likely we're going to see this point of control move up. But unless we fade back down into that 60-32 cog line and build it out enough to drag this thing up, say by today or Monday, the only way we could do that is if we fade back into that 60-32 cog line and we stay there and we build that volume out. Otherwise, we need to lose Friday, Monday, Tuesday, Wednesday, and Thursday and part of Friday just to get this volume, right? This volume doesn't start to show up until Wednesday afternoon and ends, say, midday Friday. So that's quite a bit of time. We have to pass all these candles before this gets taken off. So if we don't fade down into the cog line here and build out volume, this point of control won't move very likely for another week. That's very likely where it is going to go, though, 61.32 right up here. And the question will be, in a week, is that going to be below us, acting as support, or is it going to be above us, acting as resistance? My crystal ball is broke, so I don't know. 61.52, we hit that late afternoon yesterday. So take that off the table. The 61.37 was hit around noon or so, 1 o'clock. So we take that one off the table. I don't think we have any more up there. Nope, we don't. We also ran up and we hit the VPOC from Wednesday when we started this run back up yesterday. So we hit 3 different VPOCs yesterday. It's been a long time since we did that. $61.34 You just round it to 61.32. At least that's what I would do. Otherwise, we don't really have a classic shape. It's like a triple distribution. Not what we're looking for. Got a weird little hook on this one up here from that when that decision came out. Otherwise, we've got a, if we just ignored that, then we've got a really nice distribution down here. And we're lined up with TPO and volume profile. All right, well, normally we would get a preview of next week's range, and we don't have that preview this morning. It's a little weird. Right now, the range is 92 points higher and lower. So when we come in Monday, hopefully the indicator will be working at that point, and we'll get a better idea of this. This is not the expected move for next week because the day is not done. You'd want to come back and look at this number at the end of the day, say around 4:15, certainly after 4:15, and see what it is at that point. And it's half the number. So if we say it's 92, if we close tonight at 61.45, we would add 92 to that. That would be our upper number, and we would subtract 92 from that, and that would be our lower number. It is worth noting that we have a market maker move this morning too. So they're in here hedging. They're hedging the front end. These 0-day options are getting traded with size. So there's an event here causing them some grief or some worry. That's what we're seeing in there. So we got 19 points on the market maker move at this point. The idea behind that is we want to see when it starts to decrease. What are they hedging for, right? And it's very likely what we were talking about here. Remember, we've got a high volatility economic event here, global manufacturing PMI at 945, but not to be undone, while it's not the highest impact history, it does have an elevated impact history. It could be consumer sentiment. I don't think it is. I think it's the global composite PMI, but we won't know for sure on what's causing them to hedge until the event passes and the hedge starts to shrink. So keep your eye on the market maker move to try to identify when that number begins to turn around and get lower. It is a 0-day tool. So by the end of today, it will be gone one way or the other. That's just the way it is, right? The options that they are trading today expire today. So this hedge doesn't have a life beyond today. At some point, time will override the price of this and it will start to shrink on its own. I don't expect it to be around that long. They'll likely begin to close those hedges after whatever event it is that they're concerned with has passed. Probably around 9:45. So looking at what's up this morning, China, Bitcoin, China again and again. So this one is China, that one's China, this one also, and this one. All of those are different versions of China or different ways to see China, all up. Then we've got gold miners, cloud computing. Some weird ones that we don't see all that often. We actually got the S&P 100 The OEX up this morning. We don't normally see that. Same with the NYA, the New York Stock Exchange Composite Index this morning. Interesting. Emerging markets is another China. It's not quite up enough yet to meet our qualifications, but it's almost there. Got some Mag 7, but they're lagging behind. They're not leading. And value here also not leading, but slightly up. Looking at what's down, nat gas bond volatility is down. Okay, Russell volatility is also down. Semiconductor triple X is down. Airlines getting a little bit of a pullback. One of them had an earnings report yesterday that wasn't all that awesome, right? The Jets ETF is just a collection of different airline stocks. And one of them, kind of fumbled the ball a little bit on their earnings. So we're down a bit this morning. We got solar down, the dollar, utilities. Now, utilities is not down enough yet. We would need it down just a little bit more, but that's a really nice topping pattern as a starting point on this lower time frame. So 1 hour. Put it out on a daily, we kind of got that line in the sand like a half back to worry about. So if this is a half back rejection on that 80, then running utilities back down to 75 and then working on, a potential breakdown from there. It's a good idea. I just took Staples yesterday. We'll see if we get any more out of this. I think we've got a lot more room here. I had one, I closed it. Wanted another one. I like that pop that we got. A little move to the upside. I thought it's a good start to a new short. So with Bitcoin up this morning, Coin, Riot, Mara, Hut, Hive, Hood, those should all be getting, favorable flows. And then the China group, remember, we're expecting these to go sideways for at least a week as they close for the new year. So don't fall into that. What was it? Somebody called it yesterday, that theta trap. That's a good way to imagine it. Leave that alone for at least a week. But when we come back, I think they'll be coming back hot with a vengeance. We got this really clean downtrend in silver. If it continues, then we're at the top of the pullback before the next leg is down. Right? Just kind of visually lining this out from the run up. That was pretty clean and consistent. And then we had that blow off top. Well, now we're doing it the other way. We would be looking for, capitulation lows. we're missing what's been running the last few days, right? That whole Mag 7 space. So they are up this morning just a little bit. This is the little homemade ETF, right? So you can see the Mag 7. It's just like Tesla, Netflix, Google, kind of put them all in there together. Now I have some weights in it, but you don't need it. You can just put those names together without weights, and your chart will look really close to this. It won't matter, I promise. So we can see this morning that it is up in the pre-market, but not by very much. It certainly isn't meeting our benchmark requirement. So the move that we're seeing this morning is not being, fueled by the Mag 7 group. Now, if they don't drag us down and they just go sideways, the other 493 names can carry the market and we can grind higher. But we won't go higher if the Mag 7 starts to go down. So, if I would be looking for a tool to use today or an indicator to watch, I would watch the Mag 7, make sure they don't start breaking down collectively as a group. As long as they stay sideways to slightly higher, then we can grind higher in the markets. But when it's all said and done for the day, we've had a really good week. I don't think it owes us anything more. And I mean, if we get a breakout higher today, I'll take it. You're going to give it to me. But it certainly doesn't owe us anything at this point. And I wouldn't count on getting it unless the news that we get at 9:45 today is actually good enough to make people, forget about what's on the table next week. So with that in mind, it's very likely that the high is already in and that we don't sell off into oblivion, right? So we shouldn't even get to Thursday's entire low. Maybe at the most 61.11, which was the RTH low of yesterday. I think that'd be about as weak as we would want to get. Anything worse than that, and we'd start to question, what was so negative that took us down even that far. Hope y'all have a good weekend. See y'all next week.